Good day, I'm Chartered, your accounting tutor. In today's video and class, we are still going to continue with financial statements of a sole trader under financial accounting. And today we are going to treat one of the most fundamental, and let me put it this way, complex area of accounting, what most learners find it very difficult to handle. Accounting is supposed to be simple, but what makes learners feel is very difficult is when end of year adjustments are introduced, because most learners don't know how to handle such adjustments. But if you do not handle it well, the account will never balance. That is, the financial position will never balance, where we say capital assets is equal to capital plus what? Liability. We will never agree, because this adjustment that must be made in the financial statement to enable the account to balance. So today we are going to look at how we are going to handle all the adjustments one after another, at least that of a sole trader, which we are going to look at. So first, let's understand what is adjustment in accounting. Adjustments are changes made to items that are found in the trial balance, which are from the ledger accounts. These adjustments are done to ensure that the financial statement reflects the true view of the business transaction in accordance to international financial reporting standard practices. When we talk of adjustment, we are saying that if you post transaction into ledger accounts, it means that the ledger account should capture all the transactions that are done in a year. But mind you, some of the things are not being captured, or some of the things are not being captured the way they're supposed to be. For example, if rent was supposed to be paid 8,000 in a given period or accounting period, and it was paid only 6,000, it means 2,000 is still hanging aside. But the matching concept says that all the transactions in a given year, that is income and revenue, should be matched together. So if the other income is not brought into the ledger, it means it has not been captured. So adjustment now try to address, but it is only what was paid that will be transferred to the trial balance, because that is what we found in the ledger account. And many other things, and that is how it is. Most things that are done in a given year are not captured in the ledger account. And that is why by the time you transfer the ledger balances to the trial balance, you agree with me that the trial balance will not contain everything that happened within the year. And that becomes the basis of adjustment, that this adjustment must be done in such a way that it will incorporate everything that happened within an accounting reporting period, so that the whole transaction, the whole business view of what happened will be captured. So let's look at some of the common adjustments that are found in financial statement of a sole trader. Number one, we have what is called the closing inventory. These are the unsold goods at the end of an accounting period. Just like I explained, if goods are purchased, it is expected that all the goods should be sold. So if the goods are not sold all, that means the remaining must be adjusted to be able to determine whether the business made profit or what, loss from the goods that have been sold. Next, we have what is called accrued expenses. Accrued expenses. Just like I have given example of rent, accrued expenses are expenses that have been enjoyed by the business, expenses that the business have already received services complete in the whole given accounting period. So based on the matching concept, some of these expenses will not be paid all. So if the expenses are not paid all, the remaining balance supposed to be captured. Otherwise, the true picture of the financial statement will not be there. And that's what is called accrued expenses. Expenses that have not been paid, though they have been enjoyed, but not been paid all. So the remaining balance that's supposed to be paid is referred to as accrued expenses. Expenses that have been fully enjoyed to the end of the year, but coming to payment, they have not been paid, or they are referred to as accrued expenses. We have what is called prepared expenses, which is like the opposite of accrued expenses. These are expenses whereby the business decides to pay in advance, in such a way that if the expenses have been paid, for example, insurance, you decide to pay the insurance for 2 years, or you decide to pay rent for 2 years. The other year that have not been enjoyed, or the business is yet to enjoy the benefit of it, become what is prepaid. But because based on matching concept, it means the expenses must be Cultured. That is, the amount that is paid in advance must be what? Cultured, referred to as prepaid expenses. Mind you, we are going to be treating these adjustments one after another in detailed form, thereby including how they are done, they have been adjusted in the profit or loss account as well as the financial position, as well as we are also going to demonstrate how they will be posted or they will be adjusted in the adjusted trial. That is, we are going to prepare what is called journal entries so that we capture them in the ledger, so that we have the ability to prepare what is called the adjusted trial. And the next one is what is called accrued income. Accrued income is income that is earned by the business at the end of the year but have not been received, or income that the business have already earned by the services the business have given to anybody and is expected to receive income from such a person or such an organization, but the income have not been received, or just like rent. Here the business can decide to sublet part of the premises or get interest from somewhere or from somebody based on the transaction given to the person, but at the end of the day, the income will not be received or from the person or from the organization. Such income are referred to as accrued income, and they must be adjusted in the financial statement to reflect the true position of the business. The next, we have what is called income received in advance, which is the opposite of accrued income. This is an income that the business will earn but receive it in advance. That is, for example, if the business is to receive rent for 1 year from a customer that maybe the building or anything have been sublet to the person, if the person supposed or if the owner is supposed to pay let's say 20,000 in a given accounting period, and the business has to receive the rent for 2 years, that is 1 year will be in advance, then we call it its adjustment, because the income that is received in advance will not be included in the very year we are talking about because of matching concept. That is what is called an adjustment in that area, because the income received in advance must be adjusted because the whole amount was received in accounting period and you have to adjust it. The next one is what is called bad debts. What is bad debts? Bad debts or bad debt written off, as the case may be, is referred to the amount of money that that's supposed to be received from debtors, that's from customers or account receivables, but the amount has not been received on to the extent that either the debtor cannot pay the debts again. With one reason or another, the debts are not being collected all, and there's no way the business can there's nothing the business can do about it, and such debts are referred to as bad debts, and they are written off the book, then it becomes an adjustment. You have to adjust because the business is already recorded the expected income to be collected from the customers. So if they cannot collect it all and the other money cannot be collected, then it means it becomes bad debt. The next one is what is called allowances for expected credit losses. What you call allowances, what is called provision for bad debts hitherto. This refers to the allowances that is given to customers to expect them to pay their debts. Customers are expected to be encouraged or to ginger up to enable them to pay their debts. So for such arrangement, provision for bad debts are made on debts that the business expected to collect, but it is in probability whether they will collect it or not. So such are referred to as allowances given on debts that are expected to be collected, whether you like it or not. Based on the previous experience, it means some debts, whether the business like it or not, cannot be collected on. And then such allowances are given to take care of such money that might not be collected. Next, we have what is called depreciation. Depreciation simply means the reduction in the value of non-current assets as the time passes. So depreciation of non-current assets is very, very important because it gives a true picture of the business in respect of the assets that the business has, particularly the non-current assets. So depreciation must be adjusted to get the true value of the business in respect of the assets the business is having. It is an adjustment. Next, we have what's called allowances for discount to account receivable. Just like allowances for expected losses, we expect also have allowances for discount. Discount is a motivation for payment or motivation for payment for either goods purchased or goods paid for. So in this case, discounts are given commonly to motivate customers to pay or to motivate the business to pay suppliers. So there are also adjustments to reflect the true amount that was paid or received from either customers or paid to suppliers. It is an adjustment that should be taken care of. Next, we have what is called sale of non-current assets. Non-current assets are assets not meant to be sold, but as one reason or another, the business decides to sell some of the assets out. It means that the non-current assets can either be sold at a profit or sold at a loss. So as the non-current assets have been sold out, if they are sold at a profit or loss, such adjustment must be made to reflect the true position of the business respect of the non-current assets that have been sold out by the world business. Next is drawing of cash and goods from the business, especially that of goods. So if goods are being withdrawn, cash are being withdrawn out of the business, either at intervals, monthly, yearly, or as the case may be, the adjustment must be made to reflect the true position of the business. Otherwise, the goods or cash were meant to be used in the business. So if the owner take it out for private use and it does not reflect the double entry as was said earlier, then it means it must be adjusted to get it right so that the business will report its true financial position. Next is revaluation of non-current assets. Non-current assets are either revalued upward or downward. Revaluation is an increase in value of non-current assets or a reduction in value of non-current assets as time passes. So if any of the assets in the business have been either been revalued upward or downward, it means such adjustments must be done to reflect the true financial position of the business. So any revaluation of assets in the accounting period must be reported either in the trial balance, but if it is not in the trial balance, then it must reflect as adjustment. Mind you, I told that adjustment are things that were not done or they were not part of the double entry system of bookkeeping, which were not found in the trial balance. So if they were not in the trial balance, they must be captured so that the true financial position of the business must reflect. Next is interest on capital. This is the capital introduced by the owner into the business. If you go to partnership account, which is also part of the financial statement, you discover that in partnership account, the owner put in capital expecting to get interest, which is charged a percentage. So if such interest have been calculated, even in a one-man business as the case may be, it means that the interest must be reflected in the financial position to show the true position of the business. Finally, we have interest on drawings, which is just like they are all interest to the owner, which put in the capital and also take out the money out of the business for his private use. So if interest is attached to drawing, to some extent it discourages the owner from taking money out of the business at will. So such interest both on capital or drawing is not captured in the double entry system of bookkeeping year to later. It means it must reflect in the adjustment so that it will show the true position of the business in terms of the capital that's available in the business at the end of the period. Mind you, I say that adjustment are the most critical areas in accounting where most learners found it very, very difficult to comprehend. I am here to make sure that all these adjustments are being well treated, the lowest level or lowest help to enable learners to have access to solving any kind of question, be it professional at any level. Adjustment will be treated. I will handle them one after another. Don't forget to follow my video, like or comment, because this adjustment, I will treat them beginning from number 1 to number 14, so that each area will be handled in a detailed way, how they are treated in statement of profit or loss or statement of financial position to enable the account to always balance at the end of the accounting period. Don't forget to like, don't forget to share my video to learners that have issues in this area so the knowledge can move and everything becomes simple for all learners that are expecting to know accounting. Thank and remain chartered accounting tutor.